Is it still too soon to say I told you so? This has been the worst week in the stock market since 2008. We're going to go over a couple of charts just so you can get a visual representation of what the stock market has been doing over the last few days. We're going to dive into some of the reasons why and ultimately look at what is next. Let's dive in. All right here I've got a chart showing you the S&P 500, and so you can see February 19th here. That was the top, that marked the top where we closed today down about just about 13% off the highs. I think the funniest thing that happened on February 19th were two tweets. One, Donald Trump came out with a tweet. He just said, all-time stock market highs by far. And then Jim Cramer tweeted, he said, what the hell is happening? Where are all the sellers? So I've got it bookmarked to see how long that tweet marks the top of the S&P 500. So we're down about 13%. We rallied a little bit towards the end of the day here, but ultimately still closed below yesterday's close. If we take a look at the Dow, before we skip on to the Dow, let's zoom out a little bit just so you can see. This right here, this was back in the kind of the volatile time period of 2019, right before the balance sheet really started to expand here. So we're back down into those levels in the S&P 500. If we look at the Dow, we're down further than that. So the last time that we made that we were before we ever got above these levels, it was back in 2018 here. That was the first time we had a higher price in the Dow compared to what we closed at today. And so ultimately what that means is that if you would have sold, if you were invested in the Dow and you would have sold early 2018, right now you'd be sitting at even. You wouldn't have missed out on any of those gains because we're right back down to that same price. And then if we look at the Russell 2000, which is again the small cap, the American stocks, it's right about October of 2017 is that mark where we've erased basically everything that's happened through October of 2017, and so we just had a really steep sell-off in the markets. Now, one thing that is short term, a little bit of a positive, I think, is we hit support here. So right down along this line right in here, you can see there's strong support there all throughout 2018, right at the beginning of 2018, and then all throughout 2019, we were the Russell 2000 was bouncing off this 1450 level here. And you can see today that's right about where it bottomed out before it rallied up to 1476 where it closed today. So short term, we've encountered some technical support. And with the Federal Reserve, they came out today and basically said they're watching. They have a whole tool belt that they're willing to use. They're watching the coronavirus updates very closely. And so as soon as they said that, the market started kind of trying to price in maybe an expectation that anything the Fed might do might help. Ultimately, in my view, this is if there is any sort of a bounce or rally from anything that the government does, whether it's the Federal Reserve or the Treasury or there's a new tax cut or a new spending bill, anything, I think it's going to be short-lived because like I've been saying all along, the problems are not the coronavirus. That's just the needle that's kind of popping all of the asset bubbles here. And so ultimately, I do think that over this weekend, if I was going to, be a betting man, if I was predicting here, I would say that I think over the weekend, the markets usually kind of slow down and because the markets aren't open over the weekend. And so it's kind of like, hitting the brakes, if you will, in the financial markets. But that doesn't happen with something like the coronavirus. It just keeps on going and more updates start coming out. The coronavirus doesn't stop spreading just because the weekend is here. And so I think over the weekend, Trump or Congress or the Federal Reserve will announce some sort of surprise emergency measures to try and kind of bring in a little bit of buying back into the markets starting next week. Ultimately, I don't think that's going to last very long, though. I think that'll be a little bit of a bounce before we resume the sell-off here. Now I want to take a look at gold here. Gold just got hammered today, down about 3.5% here. But ultimately, I've got this longer term chart up here just so you can see, because it's kind of funny. A lot of people are, they've been talking about how gold got hammered today, and gold has been losing just like the market, and gold's not really a safe haven, like some of the gold bugs have been saying. But look, the last time we sold off from the last couple of days, absolutely. But if you look at this long-term chart, here's the last couple of years. This is from the beginning of 2017 through now, compared to the S&P 500. That's a very different chart. Same thing with like the Russell 2000, up and then tapered along and then boom, sell off. And so yes, we have had a little bit of a sell-off, and here's why. The majority of it looks like it has been from a lot of naked shorts hitting the market. And then a big portion of it has been margin calls, covering margin calls on leveraged equity accounts. It's when you have when you're long the market and you're highly leveraged, and it starts to fall, you're going to have margin calls and you're going to have money due basically in your account. So it looks like a lot of the gold selling has been, that was the only thing that had maintained its value. So we need to sell something that actually maintained its value so that we can, kind of pay off our debts and what's due here. So I think that this is a kind of just a correction in the bull run with gold here. And just for some perspective, this is a chart of GLD. That's an ETF that tracks the price of gold. Ultimately, the chart looks pretty much the same as the actual spot price of physical gold. We closed here right at this 148, 149 level, which incidentally is the same price as the bottom through 2011 to 2012. And so over the last 2 weeks, 3 weeks, we rallied into that heavy volume area, and then today came back down, tested the bottom of it, and bounced back up, and we stayed above that support level. And just I'll drag it back here so we can just view that price period in there through 2011 and 2012. You can see that that's exactly what I'm saying. We closed right here, right in this at the bottom of this range, and over the last couple of weeks we rallied up into here and then came down, and so we're right in this new channel again that we were in through 2011, 2012, and it held. So ultimately, short term, I don't know what's going to happen, but to me, this looks like an ultimate buy the dip, especially with gold stocks, which I actually did about more gold stocks today here. This looks like an absolutely fantastic opportunity, and for a couple of reasons that I'll go into now. First, the coronavirus, by all conservative estimates, is looking like it's probably going to infect about 30% of the world's populations. And I don't think this was Trump's intention, but the fact that he came out during that press conference and Trump said it's not a big deal, we've got no cases, it's going to zero, the flu is worse than the coronavirus. The moment he did that, I knew that the world, or at least most of America, was going to start to take their coronavirus seriously, because the mainstream media will do their number one priority is to make him look as bad as possible, right? And so that was, again, I don't think that was accurate report. I don't think that was good that he did that. But the silver lining on that is now every mainstream news outlet is doing everything they can to show how bad the coronavirus actually might be. And there's very few people out there left that are saying, hey, the flu is worse, because that's just garbage. If you know anything about math and statistics and the way that epidemics and diseases work, just do a little bit of research, you'll realize that that's just complete, utter nonsense. And so the conservative estimates are saying about 30% of the world will probably be infected, and the vast majority of those will probably be either asymptomatic or showing very few symptoms. And the kind of the more extreme estimates are saying up to 70% of the world could be infected, but again, most of those are going to be asymptomatic. And the reason it's going to spread so far is because most people are asymptomatic or have very few symptoms, and so it's basically impossible to contain, because you're not gonna get tested if you're not showing any symptoms, and you're not gonna quarantine a city if nobody in there is acting sick. And for weeks at a time, everybody's spreading it while they're infectious but not showing symptoms yet. So ultimately, the components, the way that this virus kind of works, makes it pretty much impossible to contain. So very, very likely that it spreads extremely widely, and the people who are really the oldest and the sickest are the ones who are going to take the brunt of it. And it looks like people who are really young are escaping fairly unscathed. So that's factor number one, that we haven't seen the brunt of it come through America yet. And what we're seeing in China, and some of the rumors of what's happening in China and some of the other countries where it's started to get a foothold now, that's more likely of an outcome of what we are going to start seeing in America at some point soon. I've said it before, but this means that the supply chain shock is going to have this massive ripple effect through the system that we haven't seen yet. And very soon here, if it's not, it's already starting to happen. So places like DC, you're seeing videos come out. Washington, DC, the Costco's are empty, the shelves are empty. And so this is probably your last chance to prepare and go stock up on food supplies, because if everybody right now goes to the grocery store, everybody in America goes to the grocery store to stock up on 2 or 3 weeks worth of food, there's not enough food in the grocery stores for that to happen. So this might be your last chance to actually stock up on supplies before the grocery store shelves are empty. And as soon as that starts to happen, as soon as that panic buying and storing up of goods starts to happen, guess what's going to happen? Prices are going to start skyrocketing. Now, some people might say, well, why wouldn't they institute price controls? Why would we let prices go up in a time of emergency? Well, the number one thing that you can do if you want to stop supplies from getting to an area is institute price controls. Because let's look at the masks, for instance, the N95 masks that are preventing the respirators. If they instituted price controls on that, number one, 3M would not be running their factories 24/7 and paying all the overtime and paying the probably additional money to their workers to encourage them to continue to come to work during this time to produce the massive demand for these masks. So the additional profit incentive that's available during extreme times of need is really what's necessary to encourage the factories and the companies to stay open and continue to produce what is necessary, for that demand that is spiking up. So if you throw in price controls, all the supply goes out the window, and then you actually just don't get anything you need for any price, versus no price controls means you get something that you need. It just costs you a lot more. So in summary, this might be your last chance. I would highly recommend get out there as soon as you can, stock up on food, just in case you can't leave your house for a certain number of weeks so that you don't have to go hungry, and some other things as well that I've talked about in my other videos. Now, we know that this the S&P 500, the stocks in America, this entire rally here, and ultimately longer, ever since 2008, the easy money policies that have been in effect have allowed companies to basically grow built on massive, unprecedented piles of debt. And that's even in the last year, last 6 months, it has just increased exponentially. The debt loads are absolutely unprecedented. And what the companies have been doing with that is buying their stock. And that's been contributing to the vast majority of the rallies recently. So what are we seeing right now? Number one, CEOs and officers are leaving companies at record paces. So that's red flag number one. Number two, over the last year, we've seen a spike in insider selling. Lots of officers have been selling a lot of their stock. Number three, over the last week, there are pretty much every asset class has had some sort of a hit. It's had some sort of a fall, except for one, and that's been U.S. Treasuries. What that means is that junk bonds and even investment grade corporate bonds have been getting sold off. Their yields have been spiking, which means that people are selling those bonds. What that means is that there are no more stock buybacks happening. That means that this debt is being sold. And so the only thing that's been going up recently in the last week has been Treasuries. Now, I speculated that this might be the case, and that's why in my video from 1 month ago, where I first started talking about the coronavirus before almost anybody else was talking about it, I told you if you wanted to speculate off this, you could buy some options on TLT. That's an ETF that tracks Treasuries, and it's done fantastic since then. Not a long-term play, though. It's absolutely not a long-term play. It's a dangerous play because the Treasury market is the biggest bubble of them all. And that's evidenced by the fact that investment grade bonds and especially junk bonds are starting to sell off right now. And as soon as there's enough money piling into treasuries to make US treasuries negative yielding, that will probably be the absolute top. And that will be when the momentum reverses. And that's the moment when the momentum reverses. That's when hedge funds are going to start having to sell US treasuries. And that's when the momentum will reverse against itself and they'll all start to have to unwind their trades, because the trades that they're doing right now are shorting negative yielding debt and going long things like the treasuries. And so as soon as that momentum reverses, they're going to have to unwind those trades, which is going to make that snowball effect continue even faster and faster. Treasuries are going to get sold off, yields are going to spike, and that's going to leave the Federal Reserve the only buyer of treasuries. And I've been talking about this on my channel for months, ever since probably July or August, that's what's going to happen, is that eventually people are going to stop buying treasuries, because most of treasury buying is speculation right now, and foreign investors, which have more dollars and dollar investments than the entire US GDP combined, there's no dollar shortage, there's so many dollars out there, they're going to start to sell them to, especially somewhere like China, which has the majority of US treasuries. What if they need to rely on their savings, those pile of US treasuries, to pay for things? They have a massive amount of treasuries. So especially with them having US dollar denominated debt right now, what's the smartest thing for them to do? If they can't pay their US dollar debt, start dumping your treasuries and make that debt a lot cheaper to pay off. And so it'd be very easy for this momentum, this train, this speculative bubble in treasuries to reverse itself. And the moment it does, that's kind of the final nail in the coffin for this bond bubble, this debt bubble, because it's going to leave the Fed the bag holder, and they're the only ones that are going to be buying US debt while we have a bear market, while we're entering into recession because of the supply chain shock and all the problems that have been rotting away at the inside of the system start to come out all at once. And the federal government is going to have to increase its spending because austerity is never been on the table. It's never been an option, and there's no way they're going to cut back on spending when we're entering into a hard time, especially entering into an election season. And so we just have this massive cluster storm of ingredients that are the perfect recipe for inflation or hyperinflation. Government spending about to explode, supply chain shocks rippling throughout the system, demand spiking on all sorts of goods and services, with supply just dropping like a rock. Junk bonds plummeting and their yields are skyrocketing. Investment grade bonds are plummeting and their yields are skyrocketing. The stock market risk assets are no longer going up, and so they're having to cover those liabilities by selling anything of value. Starting with the small companies that have been, swimming naked, as Warren Buffett likes to put it, they're going to start folding like crazy, and all of the massive debt instruments out there that have kind of securitized and divvied up these giant debt packages of all these junk bonds, they're going to start showing signs of weakness and breaking left and right. And we just have this massive storm where the government's going to have to start spending tons of money. The Federal Reserve is only going to be able to print more and more money to pay that debt so that yields don't skyrocket, so that the government doesn't default on their debt. Our debt is going to skyrocket. Our deficit's going to skyrocket. The money supply is going to skyrocket at the same time as supply is dropping like a rock and prices are skyrocketing. Inflation is going to completely get out of hand, and there's no way at this point that they can control it, which is why real assets, things like physical gold and silver, even real estate and commodities and goods, these are the things, the physical assets that are going to be kind of the safety assets, and those are going to be the kind of things that you're not going to lose money on or not have a huge financial loss on, because ultimately, I've talked about this before, if you have no money and you're trying to prepare for a recession, what's the best way to do it? The best way to do it is to stock up on food. And I did a video about this before there was even any hint of something like a coronavirus happening. Stock up on food, stock up on goods, things that when inflation hits, they're going to cost more. And so you're going to get a real return on your dollars by trading your dollars for goods when the dollar is worth a lot more right now than it is going to be in the future. So the end game here, I'm bearish on the US dollar. I'm bearish on all fiat currencies. I'm bullish on real assets. Ultimately, if it was me and I had to make a choice between, let's say, US treasuries or bonds and US equities, yeah, I'd still be in equities. I think debt is a bomb that you're just holding a grenade without the pin, waiting for it to explode in your hand. I would not loan money right now. I would not be a lender. And when you buy debt, when you buy treasuries and buy bonds, you're a lender. And lenders get screwed in inflationary environments. So to recap, we've had a very, very messy market this last week. I think over the weekend, we'll have some announcements that'll make a little bit of buying come in next week. But over the next couple of weeks, maybe couple of months, I think it's about to get a lot worse because ultimately companies are not on sale yet. The overall stock market price to sales ratio right now, last week it was at levels not seen since I think December of 1999, and as of the end of this week it's back down to levels not seen since November of 1999. So stocks are not on sale. We've had a big sell-off, but they are not cheap by any measure whatsoever. We have a long way to go before valuations start to look anywhere near to historically normal, right as we're entering into a recession where earnings and profits are going to drop. And so I think we have a lot of carnage left in the system to unfold. So stay tuned. I'll post another video as soon as we have a couple more days of updates and new news coming out and new market activity. Thank you for watching. If you enjoyed, please hit that like, subscribe button. You guys have a great weekend.